Welcome back. So let's get you that promised conversation on how the second quarter earnings season is going to shape up. Gautam Duggad, Head of Institutional Equity Research at Motilal Oswal, is with us for the conversation. Gautam, thanks for joining in. I think it's one of the most anticipated seasons in the last couple of quarters, only because we all want to know what companies are doing with this tax cut. Are they moving to the new regime or not? Are there tax write-backs or not? But aside of all the tax nuances, what are you expecting in the second quarter?
Hi, Subi, good afternoon. So aside of tax nuances, we are expecting more of the same. The second quarter earnings season should pan out exactly as what we have seen for the last couple of quarters. Dull and uneventful, full of downgrades. We've already seen fair amount of downgrades in this earnings season. As you rightly pointed out, there will be a lot of changes pertaining to tax rates. So the right way to look at this quarter's numbers is at a PBT level. And at PBT level, we are expecting a decline of 2% for Nifty and similar kind of decline for our broader universe as well. And even within that, large part of the uplift is coming from financials. So if you remove financials and look at Nifty numbers, we're expecting a decline of 14% at the PBT level for Nifty and around 11% for our broader universe. So across the board, things are slowing down, as also validated by the recent GDP cut by RBI by a substantial 80 to 90 basis point, and corporate commentaries for the last 30-45 days have also been very weak on the demand side. While the festive season seems to have begun well, but one needs to see whether it is a sustainable trend or not. And whatever steps that the government and RBI has taken for the last 1.5 months, I think the real impact of that will be visible only in the calendar year 2020. So for all said and done, CY19 seems like a washout year as far as earnings are concerned.
Okay, that's interesting. Gautam, hi, good afternoon. But do you think we're nearing the end of the downgrade cycle? Could this be one of the last few, or you think it's going to continue? Because if that is the case, then the market has a problem.
Anuj, what has happened in the last 6-7 months is that consumption has slowed down. If you recall, FY 17, 18 and 19, the earnings downgrade cycle was led by financials. Right now, it seems that the downgrades from financials seems to be nearing the end. We seem to have some last bit of asset quality woes still left. But by and large, if you look at the large corporate banks, the net stress loan ratio has come down significantly in the last 1 year. Same is the case as far as provisioning coverage is concerned. The PCR has gone up substantially. So one part of the market is nearing the end of the earnings downgrade cycle. But at the same time, we are now seeing the second part of the market, which is the consumption end of the market, is slowing down, which is also reflected in various subprints of the GDP data. So I would think that consumption-oriented sectors, not necessarily staples but discretionary, and where there is an element of financing involved, that is where we have to be very cautious right now as far as earnings estimates are concerned. Auto, we have seen a substantial cut in this quarter's earnings preview, a big 15-20% cut in large OEMs despite the tax benefits. We are seeing cut across the board. In fact, for Nifty itself, we have cut earnings by 4%. So I would tend to reserve my comment as far as Nifty earnings downgrade are concerned. I think there is still some downgrades left. Maybe the quantum of those earnings downgrade may be moderate from here, but the direction of the earnings still seem to be downward revision.
Okay, I'm going to take up the point you just mentioned, Gautam, about consumption becoming a bit of a concern as a slowdown kind of percolates through. Are you expecting this in Q2 itself? Will it be visible in Q3? And just in terms of aggregate volume growth, is there a rough range that will highlight this kind of slowdown?
So Surbhi, the biggest data point that is highlighting this is the auto numbers, which we've been seeing for last 12 months now. That is one of the biggest, proof of the kind of slowdown that we have seen on consumption. Staples still remains reasonably okay, even though in staples itself we have seen volume growth coming off by a percentage point here or 2 percentage point there. As far as the other legs of the consumption baskets are concerned, durables have had a good quarter. They had a very strong season last quarter, and they seem to be on a stable path, whether it is Whirlpool or some of the other AC companies. The real problem right now still seems to be automobiles, and that is where large part of the earnings downgrades are coming. On the other side, we are not seeing growth, even though there is no decline, but the growth that we had gotten used to in FY17, FY18, that growth is no longer there. So something which was growing volume growth at 7-8% is now growing at 4 to 5%, but there is still growth.
On staples, just to get that number, for staples, basic FMCG, what's the volume growth you're expecting?
So on staples, the volume growth ranges from 5% for Hindustan Lear that we are penciling in to around 4-5% for other consumer staple names. On PBT for consumer, we are expecting a 10% growth, which will be reasonably healthy, I would say, because they're also benefiting from a very benign commodity cost cycle. So now going forward, if the commodity cost doesn't stay as benign as it is now and the volume doesn't recover, then we are looking at a next round of downgrade in that space. But right now, at around 8% profit growth and 10% PBT growth for this quarter, we think that it is a relative outperformer in terms of the various sectors that we have made estimates for. If you look at auto, we are expecting a 50% PBT degrowth. For metals, we are expecting a 60% degrowth. For oil and gas, almost double-digit 10 to 12% degrowth. Pharma and IT, we are expecting an absolutely flat quarter as far as both PBT and PAT is concerned. So within that context, if you look at consumer, cement and capital goods, these are the 2-3 sectors where there seems to be some semblance of earnings growth which is coming through.
Okay, let's talk about some specifics then. Within autos, how would you approach names like, say, Maruti on the one hand and two-wheeler stocks which seem to be doing well of late, Gautam?
Yeah, so Anuj, for a long time our preference has been more towards four-wheeler because relatively we think that the competitive intensity in that space is slightly lower, and there is a structurally positive cycle which is embedded in that space, while the near term may look very difficult, and we have seen the impact of that over the last 6 quarters in terms of our earnings estimates, whether it is a Maruti or a Tata Motors or a M&M. So within four-wheeler, our preference for a long time has been with Maruti, and that doesn't change even now. Secondly, on two-wheeler, we've been very cautious of late. Incrementally, after the huge price correction, we have put Eicher as a preferred idea within the two-wheeler space, because the numbers, while on a monthly basis, they are still stabilizing in between 55 to 56,000. But we think that from here, there is a possibility of a gradual uptick in those numbers, and valuations on a relative basis are corrected. So those are the two names within the auto space, whether it is a four-wheeler or a two-wheeler that we like. But by and large, rest of the names, we still find there is a lot of problem.
Okay, by the way, just look at SBI's intraday chart now. That one is really surging. It's been one massive move on State Bank of India, so that's looking quite good right now. Gautam, the other sector of the day-to-day, one of the sectors of the day-to-day has been cement. Of course, price hike will not reflect in the quarter gone by, but what are the kind of earnings growth you expect there, and what's the call on the sector?
Anuj, so cement in this quarter seems to be a standout sector as far as earnings growth is concerned. Even though sequentially the prices have come off, but when you compare on a YOY basis, the numbers are still decent at around 4 to 5% realization growth, and input costs have turned slightly more favorable for them, whether it is the pet coke or coal or freight cost. So from that point of view, the earnings growth that we are expecting in this sector is very strong, around 24% EBITDA growth and almost 30% plus kind of a profit growth. In that space, however, one has to be very, very cognizant of the underlying volume trend, because there is a lot of seasonal variations, and then there is a regional variations also which comes into play. So in that space, our preference is Ultratech on the large cap side.
Okay, Gautam, good talking to you as always. Thanks very much for getting us warmed up. So minus the tax jugglery, I guess it will be a bit of a lukewarm season. That's what this conversation tells us. Thank you for joining in. We'll take a quick break on that note. On the other side, we start counting down to what has been a very, very positive Wednesday for the Bulls.